What's non-consensus investing? The interesting about non-consensus is that it's content neutral. It starts with the word not. And then the second term is consensus. So it says not consensus. Most of the best investments and themes over the last 10 years have generally been non-consensus. Look at this past year. If you bought JP Morgan during the bank crisis of March and April, you're at all-time highs right now. We did that, wrote about that on Twitter. If you bought uranium in the first half of this year, even through September, you did very well. And a lot of ways to approach that. Now you're seeing a lot more discussion on uranium. It's still not consensus, becoming more and more consensus, right? Last year at this time, there's a discussion of hard landing and the need for a Fed pivot. And the hedge fund short interest in the market was at the 99th percentile. It was crowded consensus short. And if you faded that, meaning you did not bet on a pivot, that was one of the best trades of last year. Not betting on the Fed pivot and going long risk assets because they were priced in. That's the premise of non-consensus investing. It's saying, instead of trying to forecast a year from now, no one can forecast. It's a dynamic world. It's a market economy. It's always adjusting. We had the most telegraphed recession last year. People adjusted. Corporates adjusted their behavior. Consumers adjusted their behavior. Households adjusted their behavior. Something else happens. Rather than trying to be an equity strategist, look at a year ahead and say, here's what I think is going to happen. Instead, look at what's right in front of your face. What is consensus? Where am I today? And guess what? That's an easier task. It's an easier task than trying to predict a bank crisis, which no one could have foresaw coming last year, or the AI narrative, which developed last year as well. It's better to look at what's in front of me now